Welcome to Corporate Transformation Partners' Strategy-Driven Transactions program. My name's Tom Nodine. I'm the Managing Partner of Corporate Transformation Partners, and I'll introduce myself and my firm in just a little bit. But for now, I'd really like to focus in on what it is we're here to do. The core promise of the Strategy-Driven Transactions program is that we will improve your company's ability to identify, analyze, close, and integrate truly value-creating transactions. Everything we do in this program, from these lectures to the exercises to our group work, all of that is geared toward that one objective, and we're committed to making sure that this promise comes true for you and your organization. And this program is designed to help you gain the knowledge and skills that you're going to need to succeed in achieving that objective. So there's simply no better way to do this than just dive straight in. So let's do that. Let's go to our first section, which is this overview of the program. Oh, and as we're going through this and all other sections, please keep notes, and especially keep track of any questions you may have. Would welcome the opportunity to get those questions either by email, by phone, or simply hold on to them until we're together in person. So let's get going. Our objectives for this section are to discuss the role of transactions and growth strategy, to define your role in transactions, to show that it's difficult for buyers to create value. This is not a necessarily easy thing to do, and we don't do ourselves any favor by saying anything else. Also, we want to present a process for creating value with mergers and acquisitions, and we want to detail both the program objectives and the structure to achieve those objectives. So that's what we'll do. So, transactions of all types will remain a critical means of achieving strategic objectives and creating value. There's mergers and acquisitions, there's joint ventures, there's equity investments where you take a percentage ownership that isn't 100%. There's minority investments that are less than 50%. There's partnerships, there's divestitures, there's contractual alliances. There's a whole range of potential deals that can be done. And the thing is, these deals are becoming more and more important to corporations. Things are changing so quickly in the world, whether it's technology or whether it's client preferences or whether it's regulations, that it's really hard to sometimes move quickly and organically build something to respond to a new business opportunity or need. And so increasingly companies are looking to, well, who else is out there that's already doing this? And what kind of a deal can we strike with them so that we gain those capabilities, we can leverage those assets and create value? So transactions are going to continue to be a very critical part of corporate strategy. So, to succeed, your team needs to develop some transaction skills. This means understanding the strategic rationale behind business combinations, identifying appropriate targets and partners, selecting appropriate transaction types, valuing targets and deals, securing and negotiating deals, and then planning for and executing integration efforts. So there's a lot to know. And this program is designed to help you develop those key transaction skills. So to realize these opportunities, businesses are enhancing their skills to identify, execute, and create value from transactions. Transactions are absolutely a team sport. You've got deal people, you've got strategy people, you've got business people, you've got functional and other people, and they all have to know their roles and how they contribute to making the right decisions at the right time. There also has to be a common process that they're all engaged in so that they know where they fit and how they fit. And there also needs to be a language so that everybody can communicate well around what they mean with certain aspects of the transaction. And of course, the people playing each role have to have the requisite skills to serve those roles effectively. So you might be in the best position to proactively identify a new target with good strategic fit, know the target's products and operations and customers, and assess which strategies and synergies might create the most value. You might be able to identify key risks and how they could be mitigated, or you might even know target leadership and other non-business factors that could prove to be really helpful. So your team has to be ready to serve key transaction roles. You'll need a transaction manager, an integration leader, you need all kinds of team members from the business side, from the functional side, etc., and subject matter experts on quite a number of topics. So, big team sport. As in sports, however, what this graph says, it is possible to lose. And I wouldn't be doing you any favor if I didn't call attention to this. So let's spend a little time on this. You know, the objective here is to create value through transactions. And what this slide tells us quite directly is here's the value that is created and or destroyed by buyers and sellers on average in transactions. Let's start with the first large blue column. What that is that's the return to sellers. So, and you see it says 22%. So let me describe what this is. This is a study that was done on close to 600 companies over quite a long, 600 transactions over a very large period of time. And what they did for sellers was they said, well, what was your stock price the day before the transaction, and what price did you get for the business? And on average, that price was 22% higher than the stock price of the company on that day. So that's what that column means. Now, you might say, well, hold it, shouldn't you look at a longer time frame? And you'd be right to think about that, because often, especially for public companies, which of course is what this study is based on, there's often some announcements beforehand around, well, maybe this deal will happen, and that gets kind of baked into the stock price. So if you actually look at a longer period of time, this 22% ends up looking more like 35%. So the first thing to think about here is sellers seem to do a pretty good job of creating value out of transactions, right? But now let's focus on the three negative red columns. The first, all three of these are returns to buyers. And I've just got to say it, average return to buyers across all of these transactions, and I've seen this study redone many, many times in my career. It always comes out to be the same thing. On average, buyers destroy a little bit of value when they do these transactions. So we're not going to end there. There's plenty of ways to create value, and that's what the whole purpose of this program is. But on average, you have to know from a buyer's perspective, if you don't know what you're doing, or if you do what other people are doing, you shouldn't be surprised that you end up with marginal or even negative value creation out of transactions. So let's take a look at the first red column. That's the buyer's initial stock price response. So of course, to figure out the impact on the buyer, you have to look at the buyer's stock price, and then once they announce the deal, what happens to their stock price? Does it go up or does it go down? And what this says is it generally goes down. And it's a little more sophisticated than that. They take a 10-day window, 10 days before the announcement and 10 days after the announcement, and they also correct for common market movements throughout that 20-day period. But the result is, as you see here, on average, buyers tend to destroy about 1% of their value when they announce a transaction. Wow. Well, you might say, well, hold it, that's not fair, because synergies of transactions take a long time to pan out. So what we really need to do is not just look at 10 days before and 10 days after. Let's go 10 days before and then a year after, or 10 days before and then maybe 2 years after, correcting for common market movements, again, as we described. And unfortunately, the answer there is it's even more negative. So this is a real mystery. Why is it that sellers do so well in transactions, but buyers have such a hard time? We will absolutely solve this mystery in actually our very next section. But for now, let's leave it as a mystery. And again, the fact is, sellers seem to have a pretty easy time creating value in transactions. Buyers, a much more tough time. Fortunately, there's plenty of things you can do to tilt the odds in your favor and actually create value with transactions. There's plenty of companies that create boatloads of value with transactions, and there are plenty that actually destroy boatloads. And of course, your objective is to be on the creation side. And that's the purpose of this program. There's plenty of things you can do to tilt the odds in your favor. To start, it helps to have the right objective, to focus on enhancing your competitive position with the transaction versus merely doing better than last year. Also, focusing on growth in value versus growth in sales or growth in earnings. We're going to see that's very important. Then, you need to focus on the right segment. What market segments are the ones at which you're truly going to win and where you have a strong competitive advantage? Then within each one of those segments, what is the right strategy? What's your way to play and what's your clear right to win? Then you also need the right process for conducting transactions, clear proactive steps, effective job aids, tools, frameworks, and support to make sure everybody does the right things at the right times. Related to that, you need the right organization with clear structure and governance and roles and responsibilities. And then, of course, you need to have the right target. It helps to focus on a target that has the unique combination of capabilities that you're seeking, and we'll show you how to clarify what those are and use that as a screening criteria. Then, you can do all of those things, but if you pay too much at the negotiation table, you've destroyed value. So you've got to settle at the right price. And that means coming up with a standalone value, which is the value of the business as a standalone entity under its current strategy, but then also a walkaway price, the price at which you as the buyer are better off just walking away from the transaction rather than doing the deal for anything more than that price. And then you also have to look at not just the value to you, but the value to other bidders. Turns out that's very, very important in determining where deals settle. So we'll talk about all that. And then finally, you can have the right objectives, the right segments, the right strategy, the right organization, the right target, and settle at the right price. But if you don't integrate effectively, you haven't created all the synergies that you thought could be there. So you have to have the right implementation and integration. That means all the necessary capabilities developed, all the value captured, and that means using the right metrics and monitoring to make sure all of this actually comes true. So, again, tough to create value from a buyer's perspective, but there's plenty of things you can do. The goal of this program is to achieve 5 core objectives. First, we want you to become familiar with the process used to identify, evaluate, negotiate, and integrate transactions. 2, we want you to be able to link key transaction decisions and activities to the goals of enhancing competitive position and enhancing value. 3, we want you to understand the tools, frameworks, and language for evaluating the transactions. 4, to develop and enhance your skills in each part of the transaction process. And 5, to know what the resources and support are that are available to you as you undertake transactions. So, this program focuses on 10 core transaction questions and all the analysis you need to do to answer them. And these questions will serve as kind of the backbone of this program. We're going to proceed through them, 1 through 10, and we're going to show you all the tools about how to answer each question. And then there's going to be exercises along the way so that you will be able to build skills in answering these questions. So the first question is, how is a transaction going to help us achieve our goals? So we have to talk about, well, what are our goals and how are we going to achieve them? 2, how are we going to work together to conduct transactions? We need to focus on, well, how are we going to organize ourselves? 3, which companies might be good targets? So we need to talk about, what is our strategy and therefore what companies would have unique strategic fit with us and how can we use that as a search and screen criteria? 4th, what synergies might be created? Of course, synergies are the reasons that 2 companies together are worth more than the sum of those businesses apart. And there's all kinds of different synergies, so being clear about what they are, when they might happen, what's their probabilities, and all of that is actually really important. And related to that is you need to do some due diligence to make sure that the synergies you suspect might be there will actually be there. So that's question 4. Then we get to question 5, the valuation question. What is the target worth to us and to other potential bidders? So we have to understand what value is, choose a valuation model, choose the right inputs for that model to get meaningful answers. So there's plenty to know about that too. Then, what risks are involved? I think we all have a good intuitive sense of the more risky something is, the less valuable it is. But when it comes to translating that kind of squishy sense of risk into specific numbers we can use in our analyses, it gets pretty tricky. So we're going to talk about defining 2 different types of risks and using one of them to calculate the cost of capital and using another type to affect our cash flows using sensitivity, scenario, and simulation analyses. Then, question 7. What type of transaction would make the most sense? as we said before, there's all kinds of potential transactions that are not just acquisitions or full-on divestitures. There's a whole range of things in between. So how do you figure out when a JV is actually better for you than an acquisition or a minority interest or something else? So we've got to go through that. Then, how should we prepare for and implement our integrations? So again, no value is created until integration is done, and there's a lot to know about the approach to integrations. Then we have to prepare for and implement negotiations. And there's a lot to know about that so that we don't lose value at the negotiations table. And then finally, how do we assess target performance over time? What metrics do we use? What are the processes for making sure we do that? And also, what are the remediation efforts that we should put in place to ensure appropriate value capture? So those are our 10 questions. And again, we'll just be walking through those as we go through the program. So we're going to teach you important analytical tools and frameworks, illustrate them on a sample company, which is a fictitious company we're calling Gleason Brewing, Inc. And then we're going to give you a chance to actually apply the analysis in an exercise involving another fictitious company called Himalaya Dairy Limited. So we've got 23 sections here. We're in the midst of our first section, which is the introduction and objectives. After this section, there's one on creating value with transactions. So because value is such a core notion, we better define our terms here. Well, what do we mean by value? What's the evidence about how investors truly measure value? So we'll present that. And importantly, why exactly is it that buyers have such a hard time creating value in transactions? We're going to solve that mystery in section 2. Then in section 3, we'll talk about organizing for transactions, all the things we need to do to coordinate ourselves for this team sport that we're engaging in. Then section 4 is assessing strategic fit. And this is a big section because in order to define strategic fit, you have to know what your strategy is. So we're actually going to talk about, well, how do you define an appropriate strategy? And therefore, given your strategy, which types of transactions, which types of targets are going to have unique strategic fit with your company? So a section on strategic fit, and then an exercise where you're going to determine strategic fit for Himal Dairy. Then let's focus on mapping synergies. So out of your strategic fit, you've gotten a sense for, well, we're going to give this to them and they're going to give that to us. And it turns out that helps you to start figuring out what the main flows of knowledge, processes, capabilities are from target to buyer and from buyer to target. And so it's really important to map out those synergies before you go into detailed valuation analysis so that everybody can at least grossly agree. Do we have the right synergies here? Do we have enough of them? Does each one make sense? And are there some that we just don't think are valid? Great to have those conversations before you do a 1,000-line valuation model. Then the exercise on mapping synergies. And then section 8 is conducting due diligence. So you don't know for sure that the synergies are going to come true, and you don't know for sure that the cash flows and the value that you think is there is actually there. You also don't know, are there some unseen liabilities or other things that we need to be paying attention to? So due diligence is a critical step after identifying potential synergies to make sure that they're really there, and also before you get into valuation to make sure that the information that you're putting into your model is meaningful, that you believe it, that you're willing to bet that the firm's money that those synergies are going to come true. So due diligence is critical. We've got plenty to say about that. Valuing transaction targets is then section 9, and we're going to go through the full range of valuation models and other models for calculating not just value, but also price that we're going to see as important. Then we have an exercise on that. Then we have a section on risk and the cost of capital. We've got a section on valuing international transactions that covers all of the things you need to think about when you're applying a valuation analysis when you're in a different currency, or maybe there's a different inflation rate, or the risks might somehow be different. So we'll cover that in our international transaction sections. Then we'll talk about selecting a transaction type and structure. When does it make sense to do a joint venture versus an acquisition, etc., and an exercise on that. Then, section 16, we've got a full section on merger integration, which is chock full of information of how to avoid mistakes that companies commonly make in integration and come up with a proactive strategy for capturing the value that you anticipated when you signed the deal. So a lot to know there. Then there's measuring transaction performance, and that talks about a whole range of different metrics you can use and which ones are appropriate for which purposes. Then we get into our decision-making in transactions, section 19. It's always people that create or destroy value. It's people that are involved in the transaction process. So understanding some common biases that we people bring to this process is critically important to avoiding some key mistakes. So section 19 is all about those and how to avoid them. Then section 20 is negotiating transactions. There's an awful lot to know about what to and not to do in transactions. And whether or not you're actually going to be at the table doing the negotiations, it's really important to understand the types of conversations that happen there so that you can understand what information is going to be important in that conversation and make sure that those who are representing your company have the right information and know how to bring it to bear in that negotiation. So that's a really important, and by the way, pretty fun section to go through. Then there's an exercise, which is our capstone case. Again, for Himalaya Dairy, by that point, you will have figured out a strategic fit. You will have mapped the synergies. You will have done due diligence. You will have valued the company. You will have done risk and cost of capital analysis. You will have selected a transaction type. You will have chosen an integration structure and a transaction type and how to measure its performance. And so then what you're going to do is find yourself in a room with others from this program, and you're going to be negotiating against each other to see who can get a value-creating deal for your shareholders. So the Himalaya Dairy is our carry-through case, and we're going to wrap it all up by summarizing all of those exercises, and you'll get to apply them in a negotiation exercise. Then we'll debrief the case, debrief the program, and that's our strategy-driven transactions program. In this program, we're going to focus on a proven framework for identifying value-creating competitive strategies and the transactions and innovations that are necessary to realize them. We call this the strategy-driven framework. So the simple idea is this. First, you have to figure out, well, what are the bases of competition within the segment in which we're operating? And then column 2 is, well, what's our current position? What's the facts around where we stand today on the factors that matter most? Minus means we're not as good as peers, plus means we're better than peers, 0 means we're about average. Then, if that's where we are today, then we have to work together to figure out what should our future competitive position be? This is the core strategy question. What strategic competitive position are we going to work toward over time? That's the third column. And when you compare the second and the third columns, you're going to see there's differences. And wherever there's a difference, we have a unique capability gap. The unique things that your organization needs to get from its current position to its anticipated future competitive position. Then the simple question is, all right, if you have those gaps, what's the best way to close them? One way is transactions, and that's what this program is about. Again, strategy-driven transactions. But it's also important to note, you might decide that there's a number of them that you can close internally or just use your internal strategic innovation capabilities to close those gaps. So this is the overall strategy-driven framework we're going to use. And by the way, that's just one of many tools and frameworks and processes and approaches that we're going to use in this program. In my career, I've had the pleasure of working with world-renowned experts in finance and valuation, in strategy and innovation, in management, and in negotiations. And again, I've plucked the best, most practical parts of their theories and approaches for this program. So we're truly standing on the shoulders of giants. You'll also be delighted to know that despite the fact that this program does involve valuation analysis, you are not going to need to program an Excel spreadsheet yourself to do all of this. We have one for you. It's called the Target Valuation Toolkit, and it's got spreadsheets in it that already do everything you're going to need to do to take a target forecast, adjust it for your expectations, do a DCF, discounted cash flow analysis of it, do a comparable multiples analysis of it, a transactions multiples analysis of it. Then also do a risk analysis, cost of capital analysis, synergy analysis, and kind of put it all together to figure out what is this target worth to us. Now, at the beginning, it may be that there's portions of it that seem like a black box. But my promise and commitment to you is that by the time we get through this program, you're going to know exactly what this model is doing A to Z. It's not going to be black box. It's going to be completely clear, transparent, white box. So good news, you don't have to do all these calculations by hand. This program for decades has been delivered in group settings in a room. And that process works really well, and we still often do it that way. But by virtue of the notion that you're watching this video, we're doing something different here. What we're doing is we're using videos so that we can kind of flip the program. It used to be the case that we do all the lectures in person, and then you'd kind of be on your own for the applications. Well, now we're going to flip that. You get to do the lectures on your own so that you can stop whenever you want, go get an ice cream, come back, go backwards a little bit, review concepts that are particularly tricky, all that stuff. You can do that on your own time. But then when we're together, we can focus on the specific issues that you want to, and very importantly, the application of all of this to your specific transactions. So really look forward to working with you in this process. You have the right to expect some big things from this program, and we intend to deliver. First and foremost, superior value creation. And of course, we can't promise you're going to win every time, but as I said, we're going to give you the tools, frameworks, and processes so that you can absolutely tilt the odds in your favor toward value creation. Second, superior processes, tools, and frameworks. As I've said, I've been corporate development leader. I've been a leader on the strategy and transaction side in consultancies, and I can guarantee you that the processes that we're using here are worldwide best practices across all of these questions that we're going to focus on. And as I mentioned, again, standing on the shoulders of those giants who are the experts in those fields. We're also going to have superior focus on your company. When we get together, what we all want to hear is, how do things work for you? What are the specific issues you would have with applying things as we've proposed? And what specific transactions might you be working on that we can focus on? You're also going to end up with superior skill development. This process is not just about you lying back and listening. This is about you doing things in exercises, negotiating, figuring things out, and gaining the skills you're going to need to be effective in transactions. And that also means superior team development because you're going to be working with a team in doing this. And that ends up building positive momentum toward transactions that can really, really help the organization going forward. And of course, this is also simply a very efficient way to go about doing transactions education. So, because we're going to be working together throughout this process, I should probably take the time to introduce myself and my firm a little bit more completely. Corporate Transformation Partners, we help our corporate clients to identify and execute value-creating strategies, value-creating transactions, as we're doing here, and value-creating innovations. So we use that strategy-driven framework with our clients. So again, our perspective is absolutely practical rather than theoretical. Personally, I'm a former lecturer at Merger Week, which is the world's most famous and long-standing public mergers and acquisitions education program. I've led corporate development and strategy for 2 separate Fortune 300 companies where we led transactions of all types and sizes. I've served as a senior partner at multiple top consultancies focusing on transactions, strategy, valuation, and innovation. I've led executive and consultant education for major consultancies and have spent hundreds of days facilitating customized training programs just like this. As I mentioned, I've also collaborated with renowned experts. I also have a degree in management from Kellogg, which is Northwestern's Graduate School of Business, and significant work toward a PhD in finance as well. I also hold a CFA and have some solid knowledge around the financing that's necessary to get deals done. But this program is not about me, it's not about Corporate Transformation Partners, it's about your company and it's about you. So when we get together, what we really want to know is, what's important to you? What's your role? What's your background? What's your experience, if any, with transactions? And what are the areas of greatest personal interest? And also sharing any hopes and fears you might have about the program. It's all fair game, and we really look forward to meeting you and working with you in this process. So that's our first section. What we've intended to do here is to say, creating value with transactions can be difficult for buyers especially. However, there's plenty of things you can do to tilt the odds in your favor. And specifically, you can do that by asking and answering 10 key transaction questions. And this program is going to give you the knowledge, tools, and skills you're going to need to answer those questions and identify, analyze, and close and integrate value-creating transactions. So, if you're ready, let's move on to our next section, which is creating value with transactions.